What's up, investors? Welcome back to AQ Markets. I know it's been a hot minute since I've made a video, but don't worry, I'm still here to talk about investing. Thank you so much for all your patience. Now, a lot of cool and good stuff has happened in the time that I've been absent from my channel. We have now 3 vaccine candidates coming from Pfizer, Moderna, and AstraZeneca that can hopefully help us return back to normal, back in 2019 when we can go to movie theaters, go out to the mall, hug each other, shake each other's hands, and not have to stand 6 feet apart from each other. So let's talk about what happened in the markets over this last 3 weeks. So over the last few weeks, the moment that we got the news from the vaccines coming out, we saw the markets roar. We saw airlines absolutely killing it. We saw cruises come back to some pretty high levels. We saw every single industry have the time of their lives because we're slowly going to return back to normal. Everyone's stock portfolios are doing well. Everyone's 401k portfolios are doing well. But this begs the question, what about the economy? So in this video, I'm going to talk about how COVID-19 impacted the stock market and the economy separately. And let's also draw some distinction between the two because they're not the same. Though they do relate in some ways, we need to understand that just because the stock market is doing well, it doesn't necessarily mean that the economy is doing well. So without further ado, my name is Ayan with AQ Markets, and you're watching this week's video about stocks versus the economy in 2020. First, let's start off with a brief overview of the stock market in 2020, how we saw some of the most insane drops in the market since 2008, and then how now we're in December and we're at record highs and still kind of rallying a little bit. So it all started in February 20th. In February 20th, the selling started to intensify a little bit when word got out that the coronavirus was making landfall all over the world and spreading rapidly. I think we had the first case in Seattle, Washington, which kind of got the United States going. And the real drops happened in the first half of March, where the overall markets were down anywhere from 7 to 13% in just single days. Looking at these 3 photos, these were the 3 biggest drops that we saw in March. Look how horrific these numbers are among the 3 major indexes. And the reasons that the markets crashed was due to the uncertainty of the future and the sheer mystery among this virus that was either making people carry on their normal day, total fine and dandy, or it was sending people to the ICU. People were not sure if this was going to be an apocalyptic event, if this was the end of humanity, or if you're like these people.
5G technology is tied to the COVID-19 outbreak.
For police in Quebec, this has fast become a familiar sight. A cellular tower set ablaze.
If this was just a conspiracy theory created by lizard people and aliens in order for their efforts to have world domination, something like that. Regardless of what the cause was at the time, people and institutions, their market sentiment completely plummeted. They sold all their stocks in the desire to have cash and bonds instead. So when the whole world was panicking, what did you think the Federal Reserve's best idea was to calm everyone down? That's right, folks. We're going to cut federal interest rates to 0. We're going to flood the system with money. We're going to crank on those printers. You get money. You get money. You get money. You get money. I mean, the Federal Reserve strategically cut interest rates to 0%, all while creating very controlled inflows of money into the system in the form of purchasing of corporate bonds, municipal bonds, and bond ETFs to further ensure that we have solid employment numbers and we also can control inflation effectively. A few months into the pandemic, we had a new society, a new way of life, a new way of doing things. Unfortunately, a lot of businesses did not survive. But on the other hand, we had these massive mega corporations profit off of it because they had a lot of available resources and a lot of cash to create products and to create softwares that would enable us to better live in this new society. And along with that, we would have to go to them for goods and services in order to conduct our way of life and in some cases, our business. Now, since a lot of these companies were found in the NASDAQ managed to recover back to where it was before the pandemic in only 3 months in June. Now, fast forward 3 more months in September, we got the NASDAQ higher than ever, and we got the S&P 500 now back to where it was. Then you fast forward to the end around November, we have the NASDAQ and the S&P 500 at record levels, and then now the Dow Jones is back to normal. Now, there were a few things that led to the market rally after the pandemic started and how we had a little bit of a V-shape within our stock market. But this increase in stock price and stock valuations was extremely lopsided. And the first thing I want to show you is this very interesting chart. As you can see by this chart, if we take out technology from the S&P 500, it wasn't until around the beginning of November that the S&P 500 recovered. Now, if you take the S&P 500 including tech, this recovered around the beginning of August, end of July time. Now, taking a look at it from an industry perspective, we can look at this chart, which is showing how these industries within the S&P 500 grew 150 days after the pandemic started, along with year to date, which is year to date's a lot more important because it's showing us a big picture of how they actually recovered or how they're doing. We could see that technology and consumer goods are absolutely crushing it. They're having a very good year. They're making a lot of money. And we can see that financials and energy are absolutely getting decimated, while the remaining industries are either they're teetering around a small growth versus small loss. Some of them are a little bit break even. But here's also another fun fact. There are 5 companies in the S&P 500 that make up 20% of it. These are the biggest companies in the world. I'm sure you can guess which ones they are. So with all that being said, we're now around the middle of December and we have all 3 indexes hitting absolute record highs. All that good news must mean our economy is killing it, right?
I'm not.
So before I talk about the economy and how COVID-19 impacted it, how it progressed throughout the year, and how we got to where we are right now, let's first make things very clear about the differences between the economy and the stock market. So at a very basic level, the economy is the consumption and production of goods and services. It encompasses individuals, companies, and the government. And on the contrary, the stock market is just an exchange where people can buy and sell and issue shares of publicly held companies. Now, the economy focuses on 2 major things. One is GDP and the other is employment. One thing that is found in the economy that isn't really represented within the stock market is something that is extremely crucial, and that is small businesses. Small businesses make up around 40 to 45% of the economic activity within the United States. And most important of all, they represent 50% of the private sector and 50% of the total employment of the United States. So, with that in mind, let's talk about the GDP and the employment numbers throughout 2020 after the pandemic and where we are right now. Prior to COVID-19 hitting the United States, we were pretty much having the time of our lives. Unemployment was at a 50-year low. We had inflation, which was right at the Fed target. Life was good. Then everything changed when the coronavirus attacked. Shout out to Avatar. We saw unemployment that has not been seen since literally 100 years ago in the Great Depression, with an unemployment rate that was 14.7% in April, with over 23 million people out of work. Now, in Q2 of 2020, we had seen GDP shrink by as much as 34.3%, and that ended Q2 with 11.1% unemployment. And just as a reference, we were around 2% unemployment prior to the pandemic. But at the same time, the NASDAQ was killing it. The new record highs. Q2 was the worst quarter because it had a full quarter of a COVID impact compared to quarter one, which had about a 1/3 of a COVID impact. So let's fast forward to quarter three now. We had some reopenings in our economy. Businesses were slowly allowing more customers and more businesses to take place. There was a few restrictions and regulations on occupancy and cleaning tables, wearing masks, stuff like that. But things weren't locked down. So we did a lot better that quarter. We actually had unemployment fall under 10%, back to around 7.9%. And we saw mega corporations hire a lot more people at extremely low wages. And we saw people just completely transition their line of work into something else just so that they can survive. So with that increase in employment, now we're back up to 7.9%. The GDP in that quarter grew 33.1%. So you're probably thinking, dang, baby, we are back on top. We're killing it. King of the world again.
Good guess, but actually no.
So I'm a mathematician by training, huge fan of math, love numbers, love calculating things on them. So let's do that right now. Let's say we got 3/4 of GDP growth and decay, which, hey, we do. Quarter one was -5%, quarter two was -34.3%, and quarter three was 33.1%. At the start of the year, let's just pretend our GDP was 100 as a baseline. And what we're going to do is we're going to apply each growth and decay to that 100 sequentially. After quarter one, we lost 5%, we're down to 95. Then after quarter two, we take that 95, we lost 34.3% of that. Now we're down to 62.4. Now, this supposed comeback in quarter three, where we're up 33.1%, from 62, we're at 83. So, while quarter three sounds like it's a party in the USA with Miley Cyrus, we are still down 27% on our GDP, while the NASDAQ and the S&P 500s were the ones that were actually partying. Now, as it stands today, we're in a much better unemployment situation. Right now in December, we're about 6.7% unemployed, but there's one important factor that is a lot more important than that, which is not really mentioned, and that's underemployment. Underemployment is essentially working a job that is either part-time, it's done for income-related reasons, or it's a job that is significantly below your skill set. Due to the pandemic, a lot of people had to take jobs in order to survive, and the overall underemployment level saw a dramatic increase within this year. And year over year, as you can see by this chart, it's a 5% gain. We have 12% of employed people who are underemployed. And this has a negative impact on our economy for two main reasons. Because one, the skills of those people are being underused and basically not utilized. And along with that, these people are making far less money and therefore consuming less than their potential. As we proceed through time, there are two incredibly important pieces of information and charts that we should be looking at. One is the initial joblessness claims, which are the amount of people that file for unemployment the first time this year. And we also have the non-farm payroll jobs added, which shows a month-by-month increase of how many jobs were added to the economy. Now, as we can see by these two charts, you would ideally want to see them move in opposite directions with the claims going down and the payrolls going up. Unfortunately, that doesn't really seem to be the trend here. We could see that the non-farm payrolls are actually kind of trending downwards, and along with that, we could see that the claims are fluctuating. They're going up or down in certain weeks. And another extremely scary thing that is coming soon is that under the PPP loans that were extended for 24 weeks, they state, and this is a quote from their website, that if you haven't returned to proper business functioning, then you will be allowed to lay off more people, essentially. So by the time December rolls around, just after the holidays, there more than likely is going to be a massive influx of unemployed people hitting those unemployment claims, which is very sad and very concerning. So that's where we are today. We have GDP roughly down 20%. We have unemployment around triple the unemployment where it was prior to the pandemic starting. But for some reason, we are at record levels of the stock indexes with the S&P 500, Dow Jones, and NASDAQ hitting insane record highs during all this that's going on. And oftentimes a big argument question that comes up is, okay, well, if people own stocks, then that means that their market rally has caused an economic benefit to them because now they have more money or more assets. Now, sound argument. However, let's talk about some quick statistics about stock ownership to hopefully dissolve that. We have 70% of the stocks are owned by institutions, and we have 55% of Americans who own stocks. We have 13% of American workers who are on pension plans, and then we have 32% of Americans who have 401ks. And now this is where it gets really bad. The top 1% of families in an income bracket have 52% of the shares that Americans own. The top 10% of families income bracket, they own 87% of the stocks that owns. Now, if you take the bottom 50% of households, they only have a measly 0.7% of stock ownership of American families that own stocks. So unfortunately, as you can see from these statistics, there was just a massive increase in wealth inequality this year, which is never a good sign of a strong economy. And it's frankly very disheartening because there's a lot of Americans suffering. And even though the stock market's rallying, they're not seeing any benefit of that whatsoever. So before I sound all preachy, let's talk about the main point of this video. And that's talking about how these two are related and how more so that the stock market depends on the economy in the long run. So oftentimes when information is posted about the economy, it's already happened. And this is why the economy and this data is known as a lagging indicator. We get these GDP and unemployment numbers after the fact it's already happened since it's talking about a prior time period. On the contrary, stock prices are based off of expectations, which means that they are leading indicators of what a company is worth or eventually going to be worth. And oftentimes when we're making these valuations, we need to know how the economy is doing and then forecast those values in order to figure out what the expected revenues, expected profits, and the expected earnings per share that these companies are going to be able to generate over the course of these time periods. That's why it's called a leading indicator. Now, a very basic example of how this all works is, let's take Apple, the company, for example. If a bunch of people are unemployed, who's going to buy iPhones if they can't afford it? This is an economic component that goes into the expected revenues of Apple and hence gets us a stock price. So as it stands right now, a very important question that I ask myself and I encourage you guys to also ask yourself and look into is the current stock market valued based off of the current economic situation. And the only caveat to this is that oftentimes over time, we're going to see that the stock market will handle certain economic data differently. There are certain time periods of the US stock market where GDP growth meant nothing. It could be up or down, stock market's still going to do whatever it wants. There could be times where there's a straight up proportional correlation between how the GDP and the stock market do. This is something that's constantly evolving. It's something that always needs to be monitored. But the moral of the story is that a strong economy will yield a strong stock market. As time progresses, all of the data and statistics that I was talking about during this video are pieces of information that I find extremely crucial to understand and to monitor if we want to be a successful investor. I encourage you guys to take the effort to check on these numbers weekly and monthly in order to be more informed about the stock market and, most importantly, the economy. Over this next year, we're going to see the vaccine rollout. We're going to see a lot more 100% reopenings. We're going to see how effective this vaccine is, and we're going to see, hopefully, a society where COVID-19 is gone and we can return back to 100% GDP and 100% economic activity and all that jazz. But in the meantime, be wary, be cautious, understand your risks, and most important of all, invest wisely and diversify your portfolio. That is all for this week. I hope you guys enjoyed. If there's anything you have any further questions on, or there's any questions in general, please drop a comment below. Most important of all, if you enjoyed this video, please give it a thumbs up and also make sure to subscribe for the next video. I'll see you guys next time. Thank you.